Major liquidity-driven surge, global and Indian markets have taken a breather. After hitting a high of 29,045 last week, the BSE Sensex is now around 28,726. Now, the decline in itself is not much, given the markets have been steadily rising after having touched around 23,000 in late February this year. The Sensex fell 500 points last week on the heels of big sell-offs in Asia and American markets, but also recovered somewhat on Friday. Now, the big global concerns were rising bond yields and worries that the Federal Reserve may have raised rates. Now, strong markets have also seen many companies pushing through with their initial public offers, and state-owned enterprises are waiting in the wings. The larger question is, how strong is the base in Indian markets? Why is India being impacted in this way, and what way could it go? And how do we interpret this current volatility? Until when could it last? To discuss this, I am joined by Dipen Mehta, member of Bombay Stock Exchange, Devendra Nevgi, CEO of Zyphon Advisors, and Ashish Kyal, founder of Wave Strategy Advisors. Thank you all for joining me. Ask this one to you, Ashish, first. How strong is our base? I mean, where do things stop, or where do things sort of slow down?
So last time we discussed that the entire rally is probably liquidity driven, and that is what has led markets on the higher prices rather than any strong fundamental reason. So I still live by that, and I think the sell-off which we saw just last Monday was a significant example of how risky we have become. And it's not just India that has sold off. If you check on Monday's chart, it was Asian market, it was Dow Jones, UK markets, it was Brazil, Hong Kong. So it was a broad-based sell-off which we saw in a single day, and it has been almost 4 days. Still we have not able to fill up that gap. So it just shows how sensitive we are right now. And the valuations, if you check, is definitely expensive. There will be a lot of reasoning which will come in and say that these valuations are justified, and every time the PE ratio, trailing PE ratio reaches around 24, 25 levels, there are some justifications that comes in, but definitely I doubt that that is sustainable at current levels. Either the earnings have to catch up with the valuations, or market should consolidate and correct in order to justify the high valuations that we are claiming right now.
Right, and therefore maybe we've seen strong domestic flows, right, while we are also seeing very strong international or foreign portfolio flows. To what extent can the domestic flows hold our bottom, even if we don't put a number to it?
Okay, so for example, there has been a lot of foreign inflows that has been coming in, and also DIs, if you check over past few weeks, have been a major sellers. So what will happen in case there is some amount which is then pulled out of the economy or pulled out of the markets, then we can we can be very cautious at that stage. At the same time, one very important aspect that one should look at is the advance decline ratio. That measures what is the overall breadth of the market. Now, in this entire rally which started on Nifty at 6825 in February 2016 from the budget day, the entire rise has happened on a lesser number of stocks participating. So the advance decline ratio has been constantly deteriorating, which shows that there has been lesser and lesser number of stocks that are participating in the rally. And a true bull market, we need to see participation from majority of the stocks, because if the economy is truly going to do good, then it's the smaller and mid cap companies that should outperform. So even when the mid cap and small cap indices are at new highs, the number of stocks that participated in the rally has been very less.
Right. So Dipen, you pointed out some of the outlook.
See, over short to medium term, I think the rally is overstretched. We should see some kind of a correction, and right now retail participants should use a very strict stop loss or risk they need to manage very well, because there can be sudden reversals which might happen. Over the long term horizon, from 5 years perspective, I am extremely bullish on Indian markets. We should definitely do much better from here on, but short term, definitely it's time for us to be cautious.
Ashish, thank you. We've run out of time.